Welcome back, it's JWalter here. One of the largest home builders across the United States, Lennar, released their earnings report for Q2 of this year. They actually just released this last week at the time of this video, and they reported some strong signs that home buying demand is decreasing, and they're starting to do some price reductions and giving buyers incentives across the United States. They also identified some markets across the United States where home prices have started to decrease, and they're giving more buyers more incentives to buy houses there. So Investopedia.com stated the following here. Homebuilder Lennar posts a strong Q2 earnings report here, but warns that rate hikes are starting to have an impact. And this was posted on the 21st of June. Ever since this earnings call here, and I'm going to be going over the actual earnings call with you guys here in just a little bit, but ever since then, their stock for Lennar has been increasing. They're up 9.37% over the past 5 days. However, though, over the past 1 month, their stock has fallen 11%. And also, year to date, their stock has fallen 35%. In addition, their stock has fallen almost 27% from 1 year ago. So a lot of home builders right now are being really challenged regarding rising mortgage rates, which is causing a lot of home buyers to really back out of this housing market. So I actually went onto Lennar's website here, and this is their investor relations website here. So they actually had a conference call for Q2 of this year, and they had that on the 21st. So what I want to share with you guys today is their transcript from this conference call. And here it is right here. And this is, again, their second quarter earnings conference call. And by the way, for Lennar, their second quarter ended May 31st. So this includes May's numbers, which is very important to look at because mortgage rates have been increasing greatly ever since Q1 of this year. So Lennar's executive chairman, Stuart Miller, had this to say regarding Q2 of this year. And he said the increased new orders by 4% year over year, even though we began to see signs of weakening in the overall housing market. This weakening has continued into the third quarter. So they basically said they saw 4% more new home sales compared to 1 year ago. However, though, they're seeing some weakening in their overall housing market. And he went on to say the following here. The housing market has cooled as expected in response to the Fed's aggressive and rapid reaction to inflation. As you guys all know, right now we have over 40-year highs for inflation. And of course, the Fed is raising the federal funds rate in order to combat that. The resulting very rapid, almost doubling of the 30-year fixed rate mortgage in 6 months has had the desired effect of slowing price appreciation and moderating demand by increasing monthly payment costs and reducing affordability. So in other words, he's saying that the rapid rise in mortgage rates is causing home price growth to slow, and also it's moderating home buying demand. And he says here, while the market has cooled, it is clearly not stopped. I mean, he's absolutely right. The housing market's not crashing right now. We are seeing some signs that our housing market's slowing down, but it's definitely not crashing. It definitely has not stopped. And also we can see that when looking at the data itself. So when we look at the US Census Bureau's data, a video I made about a day ago, the number of new single family home sales actually increased from April to May. So we had an increase by 10.7% from 1 month ago. However, compared to 1 year ago, we're still down 5.9%, but this increase by 10.7% compared to 1 month ago is a sign, of course, that our housing market is not crashing. But it's worth mentioning that this is only 1 month of data where home sales actually increased compared to 1 month ago. So we'll have to see this trend continues. But if I had to guess, we're going to be seeing a decrease in home sales for new home sales and also existing home sales in the months to come because of rising mortgage rates. And so going back to this earnings call from Lennar, they said, and although we have adjusted some prices in many markets, in other words, they have reduced prices in many markets, those prices remain higher on a year over year basis. So even though they're reducing prices in some markets, which I'm going to be sharing the actual markets here just in a little bit, the prices we're seeing right now, even after the adjustment, is still higher than 1 year ago. And the chairman went on to say the following here. Supply remains limited across the country, and the need for affordable workforce housing continues to be at crisis levels. So of course, he's saying we have a lack of houses for sale across the United States, but they also are having a very hard time finding affordable labor. So basically saying that we're at crisis levels in order to find affordable workforce in order to build these houses. And he says the rapid increase in mortgage rates, together with price appreciation, have created at least sticker shock and perhaps a more structural cooling of demand. So because of rapidly rising mortgage rates, that has cooled home buying demand, according to Lennar here. And he says here, the market has been changing and we are getting ahead of it by making all necessary adjustments. So as I've been reporting to you guys, part of these adjustments that builders have been doing is pivoting away from building single family houses and building multifamily properties. And the vast majority of those multifamily properties are apartment buildings that they plan to rent out. But don't take my word for it. Here's the actual data from the US Census Bureau, and this is for May. This was just released about a week ago. I made a separate video regarding this. But here is the number of permits pulled for single family units. So for single family units right now, at a seasonally adjusted annualized rate, we're down 7.9% compared to 1 year ago. However, for 5 units or more, and approximately 90% of these are apartment buildings in which they plan to rent out. These are not condos and townhomes. The vast majority of these are apartment buildings. When you look at those, look at this. Permits pulled up almost 20% compared to 1 year ago. So builders right now are really focusing on building multifamily properties, apartment buildings, rather than single family houses, which are more impacted by rising mortgage rates. So in other words, one of the necessary adjustments that builders are doing is pivoting from building single family properties and building multifamily instead. And what they're also doing is adjusting home prices as well in order to make these necessary adjustments. And he goes on to say the following in this conference call for their earnings report for Q2 of this year. We recognize that interest rates are rising and inflation continues to be a legitimate threat. We know that the Fed is determined to curtail inflation, and this will take some time. But we also know that we can adjust as the market changes, and we will. They also recognize that they have difficulties in the supply chain as well. And they also noted here that land and labor remain in short supply as well. There's been a lot of reports that home buyers are basically backing out of buying these new houses, and they actually touch on that right here. It says our cancellation rate, in other words, home buyers backing out of their contracts, their cancellation rate during the quarter, which is of course Q2, totaled 11.8%, and that actually increased during the quarter. But it's still significantly below our long-term historical average. And he says here they had approximately 250 completed houses in which they basically were not sold yet. And that is putting them in a great position in a softening sales environment. So in other words, if they had a very high amount of houses that were completed but not yet sold, they would be in a very bad spot because they have a lot of holding costs in those houses that are completed. And if they're building houses and they're completing them and they're not selling them, then of course their business is going to be at risk. And here's a look into the future because they actually touched on what they're seeing right now in June. So it says, so far in June, new orders, which in other words for buyers signing contracts for buying new houses, that's a new order. So new orders, traffic, in other words, potential home buyers touring houses, for example, sales incentives and cancellations have worsened in many markets due to a rapid spike in mortgage rates and headwinds from negative economic headlines. In other words, because of rising mortgage rates, these headlines regarding a housing market slowdown, and of course, a potential recession later this year and potentially next year. And he goes on to say the following here. Many markets have also slowed as we've entered a seasonally slower part of the year. And that's definitely true. We tend to have a slower housing market in the summer months as a lot of people spend time traveling and not looking for houses to buy. However, though, when they're looking at a decrease in new orders, a lack of traffic, and also more sales incentives that have to be given to home buyers in order to sell houses, and of course, increases in cancellations in June is obviously not a step in the right direction if you're a home builder. And they actually provide some very clear guidance regarding the housing markets right now, which are basically flat, and also the housing markets right now across the United States that are severely impacted by these rapidly rising mortgage rates. So here's how they categorize them. They say 1 markets are those that have no to minimal impacts on their housing market there, and 2 markets reflecting modest impacts, and 3 markets reflecting more significant impacts. So it says here during the second quarter and so far in June, we've had 19 markets that continue to perform well. And these are the 1 markets reflecting no to minimal impacts regarding the markets there. And those markets include 6 other Florida markets: New Jersey, Maryland, Charlotte, Indianapolis, Chicago, Dallas, Houston, San Antonio, Phoenix, San Diego, Orange County, and the Inland Empire. So in other words, these are their best performing housing markets because they have no to minimal impacts. And it says here all these markets are benefiting from extremely low inventory. our sales pace and pricing power has started to flatten or has flattened in each of these markets. And also to maintain sales momentum, we have offered mortgage buy down programs and normalized market incentives. So in regards to mortgage buy down programs, what I believe they mean is paying points in order for home buyers to get a lower mortgage rate. And what they're saying here regarding normalized market incentives, these would be things such as free builder upgrades. So maybe they give a home buyer $10,000 worth of upgrades for the house, for example. And of course, these builder incentives could be things like upgraded flooring, upgraded appliances in the kitchen, upgraded cabinetry, and much, much more. All right, so that was category 1 markets, in which those are their best performers. But let's have a look at category 2 markets, which are the markets that have modest impacts. And it says here our category 2 markets, which reflect a modest softening in prices and a slowdown in these markets, includes these 10 markets: Atlanta, Georgia, Colorado, Charleston, Myrtle Beach, Nashville, Philadelphia, Virginia, the Bay Area or the San Francisco Bay Area, Reno, and Salt Lake City, Utah. In each of these markets, traffic has slowed and we've had an uptick in cancellation rates. And while inventory is very limited in these markets, we've had to offer more aggressive financing programs and targeted price reductions to keep our sales pace in line with our production schedule. This is a very big takeaway because they're basically saying here that they're doing targeted price reductions on some of their houses in these markets here, which is a big red flag because the last thing builders want to do is reduce prices of their houses, because the houses right now, or the prices right now of houses, support future prices of future houses. So if they start to do reductions on home prices right now, that's also going to cause price reductions for future homes that they build. So the last thing that builders want to do is reduce their asking prices on their houses. They are much more inclined to give home buyers more incentives like free builder upgrades instead. Okay, so that was category 2, but let's have a look at the worst category, which is category 3. It says here, this reflects a more significant market softening and correction. And these include these 7 markets here: Raleigh, Minnesota, Austin, Texas, Los Angeles, the Central Valley, Sacramento, where I live and work as a real estate agent, and Seattle. And what's really great about this is they talk a little bit about each of these markets here. So here's what's going on in Raleigh. It says they have an extremely strong market there in the second quarter, but has now softened. In the Minnesota market, it's been very challenging. There have been a strong pushback against current pricing there. And they say here in Minnesota, they have very little immigration, a lack of people moving into Minnesota, and therefore they have a limited pool of only local buyers there. In Austin, Texas, cancellation rates have increased and we've reduced prices. They've also offered extremely competitive mortgage programs to these home buyers. In Los Angeles, the Central Valley, and in Sacramento, they've seen a significant slowdown with traffic dropping off considerably in late May and into June. They say here cancellation rates have increased. We have adjusted prices, in other words, they've reduced prices, and are using financing incentives, and in some cases have included blank solar systems as part of our home package to rebuild sales. So what I'm guessing what they're saying here regarding solar systems is that perhaps they're giving free solar systems to home buyers in these marketplaces. Historically speaking, at least over the past several years, is that the home buyers that are buying houses, they're basically getting solar systems that are leased. So perhaps they're saying they're giving home buyers right now in these markets, or at least some home buyers, solar systems that are owned by the home buyer. So in these marketplaces, Los Angeles, the Central Valley, and Sacramento, new order prices are still higher than 1 year ago. However, though, the issue continues to be a reset in pricing to solve the mortgage payment crisis. And here's what's happening in Seattle. Buyers have pushed back for a reset in pricing. In other words, buyers are not willing to pay these high home prices in Seattle and also in these other marketplaces here as well. They're also seeing a significant pullback in sales in May and also in early June. And this pullback is a result of both continued price appreciation in the first quarter, causing concern over values being overpriced, and stock market corrections, which have had a direct impact on employee stock compensation plans. But once again, in this market in Seattle, we are at prices that are still much higher than 1 year ago. They also had a great discussion regarding supply chain issues that they're facing right now as well. It says here there were still disruptions to the supply chain and also increases in construction costs. And these construction costs in the second quarter of this year for Lennar are up 20% year over year. However, though, they're saying that this percentage is still lower than the first quarter of this year, and also compared to the fourth quarter of 2021, where their gains in construction costs were actually higher. And interesting enough here, they say rising labor costs accounted for all of the increase in the second quarter of this year. So the vast majority of their rising construction costs are due to labor challenges they're facing right now. So in regards to construction costs, here's what they had to say about material costs. Material costs were lower due to the lower price lumber from starts in the second half of the year. So they're saying here that lumber has been decreasing, and so the increase in construction costs is really from rising labor costs more than anything. And this drop in lumber prices is also what we're seeing regarding the futures market as well. So in regards to lower price lumber, have a look at this. Here's the commodity prices for lumber year to date. So we basically started the year at approximately $1,147, and now we're at $611. Obviously, this is far lower than the all-time record highs we saw of $1,700 in May of 2021. But year-to-date, lumber's futures prices are down 47%. And it says here the current drop in lumber prices that we are experiencing, which started near the end of their second quarter, which is of course the end of May, will lower the cost of our starts in the second half of this year and related deliveries in the first half of 2023. And after this segment, they basically open it up to Q&A. And they actually had one person here, Stephen Kim, had a couple of really good questions to ask. So he basically asked about their exposure of cancellations, meaning home buyers backing out their contracts. And they also asked about single-family rental business. In other words, builders building houses in order to rent out. And here's what Stephen Kim asked about regarding the rental market here. It says, I know that the single family rental appetite to acquire units has been really strong. And he says here, he's just wondering if they could talk about the company's ability to actually benefit from these rising rental prices. So in regards to these cancellations, here's what Lennar had to say. And we basically said here they made a very big effort to lock in people's mortgage rates in Q3 and Q4 for their closings for these quarters here. And therefore, when people actually close on their houses, their mortgage rate is in place, but also more importantly, their interest rate is locked. So what I personally gather from this is that for people who are closing on their houses in Q3 and Q4 this year, they made a very big effort in order to lock in these people's mortgage rates. So in regards to single family rentals, it says here, according to Stuart Miller, who is one of the execs at Lennar, he says the entire rental market is interesting right now. And at the end of the day, we're probably going to push more people from home ownership towards rental. That means multifamily. As I've been reporting to you guys, builders are transitioning from building single-family houses, and they're more instead inclined to build apartment buildings in which they plan to rent out. But he also says here they're building single-family for rent as well. And he says here there's going to be some dynamic shifting that moves around all these in these areas. This is very interesting because he basically said here they're going to push people out of home ownership and moving them towards rentals instead. So comment below with your biggest takeaways from today's video. Hope you guys got a lot of value out of today's video. Hope you guys have an awesome day. Look forward to seeing you on the next video.